The program explores complexity within financial markets and structured products, emphasizing how uncertainty, opacity, and complicated financial engineering can affect investment risk and decision-making. Structured products combine traditional financial instruments with derivatives to create customized payoff structures tailored to specific investor objectives. While these products may offer attractive features such as enhanced yield, downside protection, or targeted exposures, they also introduce significant complexity regarding valuation, liquidity, and risk assessment. The program explains that complexity can obscure underlying risks and make it difficult for investors to fully understand how products behave under changing market conditions. As a result, investors must carefully evaluate both the structure and incentives embedded within complex financial products and strategies. Uncertainty, ambiguity, and opacity are major challenges associated with structured products and alternative investments. Uncertainty refers to situations where future outcomes are difficult to predict because of changing market conditions or incomplete information. Ambiguity arises when investors lack confidence regarding the probabilities of potential outcomes or the reliability of available models. Opacity occurs when product structures, asset exposures, or valuation methodologies are difficult to understand or insufficiently disclosed. The program emphasizes that these characteristics can amplify investor vulnerability during periods of financial stress because market participants may react unpredictably when risks become difficult to quantify. Effective due diligence, transparency, and strong governance therefore become essential for managing investments involving complex financial structures and derivative-based exposures. Asset and strategy complexity often emerge when investment products combine leverage, derivatives, illiquid assets, or multilayered financing structures. Complexity may increase because of nonlinear payoff profiles, embedded optionality, or interactions among multiple risk factors. The program highlights that some complex strategies are intentionally designed to exploit market inefficiencies, while others become unnecessarily complicated due to product engineering or distribution incentives. Complexity itself is not inherently negative, but investors must understand whether it creates genuine economic value or merely obscures risk. Structured products may also exhibit path dependency, meaning returns depend not only on final outcomes, but also on the sequence of market movements. These characteristics make valuation, hedging, and risk management significantly more challenging for investors and financial institutions. The program also discusses case studies involving complexity and perverse incentives within financial markets. Perverse incentives arise when compensation structures encourage excessive risk-taking, inadequate disclosure, or behavior that benefits intermediaries at the expense of investors. During past financial crises, some structured products were designed or distributed with insufficient consideration of long-term sustainability and underlying asset quality. Complex securitization structures sometimes obscured deteriorating credit quality while creating incentives for aggressive lending practices. The program emphasizes that investors must evaluate not only the product itself, but also the incentives facing managers, originators, and intermediaries. Understanding incentive structures is therefore essential because conflicts of interest can significantly increase systemic risk and contribute to poor investment outcomes. Asset-based lending, ABL, is another important topic. ABL involves extending credit secured by specific assets such as receivables, inventory, equipment, or real estate. These financing arrangements are commonly used by corporations, specialty finance companies, and private credit investors. The value and liquidity of the underlying collateral are critical determinants of lending risk. The program explains that ABL structures can provide attractive risk-adjusted returns because secured claims may offer enhanced recovery prospects during borrower distress. However, risks remain significant, particularly when collateral values decline rapidly or become difficult to liquidate. Investors must therefore evaluate collateral quality, borrower financial strength, legal enforceability, and market conditions when assessing asset-based lending opportunities. Asset-backed securities (ABS) represent structured financial products created by pooling underlying assets and issuing securities backed by the resulting cash flows. Common collateral types include mortgages, auto loans, credit card receivables, and consumer loans. ABS structures redistribute credit risk across different tranches, with varying levels of seniority, yield, and loss protection. The program highlights that securitization can improve market liquidity and expand access to financing, but it also introduces complexity regarding credit analysis, correlation risk, and valuation. During periods of market stress, assumptions regarding default behavior, liquidity, and correlations may fail unexpectedly. Investors in ABS therefore require sophisticated analytical capabilities to evaluate collateral quality, structural protections, cash flow waterfalls, and systemic risks associated with securitized financial products.